Welcome back to the Deep Dive, and specifically to the fifth installment of our Financial Intelligence series. Your daily briefing is here, ready to cut through the noise, identify the most critical trends, and really understand the why behind the market movements impacting your world. Today's Thursday, August 14th, 2025, and we're taking a deep dive into yesterday's, electrifying market activity from August 13th. Our mission, as always, is to distill the core insights from our sources so you, our listener, can feel truly well-informed, ready to navigate these complex waters.
And electrifying is definitely the right word. We saw equity markets not just rally, but, hit record highs across the globe, driven by a very distinct optimism that's really permeated the financial air.
Yeah, quite something.
So we're going to pull back the curtain on what's fueling this impressive surge and, perhaps more importantly, peer into what could come next as these narratives, keep unfolding.
Okay, let's jump right into that big picture then, because the primary headline was indeed a truly global equity surge. Here in the U.S., August 13th wasn't just another strong day. Stocks were setting fresh milestones. The S&P 500, that broad barometer of market health, closed 0.32% higher at 6,466.58. Now that number, it might seem small, but consider this. It marked its 17th record close just this year. That's a powerful statement.
It really is. And the momentum wasn't just there. The NASDAQ composite, heavily weighted towards tech, added 0.14% to reach 21,713.14. That logged its 20th record close of 2025.
20, wow.
Yeah. And then you have the Dow Jones Industrial Average, the traditional blue chip index, which jumped a significant 1.04% to 44,922.27. These are not just sort of incremental gains. They represent a sustained upward trajectory.
Phenomenal numbers. Now, when we talk about what's driving this core movement, both here and internationally, you immediately point to rate cut optimism. Can you unpack that for us? What makes this particular narrative so potent right now?
Absolutely. The engine behind this current rally is the market's conviction that interest rate cuts are on the horizon. This ties directly back to the cooling July inflation data that hit the wire recently. That data has significantly increased the probability of a September rate cut from the Federal Reserve.
Okay.
And what's fascinating here is how quickly investors have priced this expectation in. They're essentially betting that easier monetary policy is coming, which generally makes borrowing cheaper for companies and consumers, fueling economic activity and, by extension, corporate profits.
So this optimism starts largely from U.S. Fed expectations,
Right.
but it definitely didn't stay just within American borders. How did this sentiment ripple out? How did it trigger a global risk-on rally? Because Europe's stock 600 was up 0.54%. And in Asia, Japan's Nikkei 225 gained 1.30%. Hong Kong's Hang Seng surged an impressive 2.58%. It wasn't just a U.S. party, was it?
Not at all. Not at all. What's fascinating here is how quickly and uniformly investors embraced risk across different regions, from New York to Frankfurt to Tokyo. It suggests a strong global interconnectedness in how central bank policy, particularly the Fed's potential moves, influences investor behavior worldwide.
Right.
The narrative is basically, if the world's largest economy is heading toward looser monetary conditions, it creates a more favorable environment for growth and asset appreciation, everywhere. This update, by the way, is powered by NextSight. They're an amazing intelligence company behind these insights, crafting them through their open-source ERSINT platform, SiteConnect. They build and customize intelligence reports to fit each client's needs. Want to explore more? Check out nextsite.com.
Good to know. So it's clear stocks were the star. But with such a dominant narrative, how did other asset classes respond? What did we see in bonds, currencies, commodities? Were they telling a consistent story?
That's a crucial question, yeah. Because a true deep dive requires looking beyond just equities. On the bond side, long-term rates retreated, which is, a classic signal of easing expectations. The U.S. 10-year Treasury yield, a benchmark for everything from mortgages to corporate debt, dipped to 4.24%.
Okay.
Concurrently, the U.S. 2-year yield was at 3.67%. Now, when the 2-year yield is lower than the 10-year, it leads to a flattening of the yield curve.
Right. I've heard that term. What does that indicate exactly?
Well, typically it indicates either reduced long-term growth expectations or, as is likely the case here, a strong belief in significant near-term rate cuts from the Fed. That compresses the difference between short and long-term rates.
So the bond market is essentially confirming the rate cut narrative from its perspective. What about currencies and commodities then? Did they follow suit?
Precisely. In currencies, the dollar index, the DXY, which measures the U.S. dollar against a basket of major currencies, it eased back to 97.786. A weaker dollar often makes commodities priced in dollars more attractive to international buyers.
Makes sense.
And this certainly provided a tailwind for precious metals. It helped gold rally significantly to $3,358 an ounce and silver to $38.45 an ounce.
Their move there, too.
Definitely. Now, for oil, Brent crude settled at $65.63 a barrel, actually down 0.74%, and it's currently on pace for about a 9.5% month-to-date decline.
Oh, interesting. Down. Why is that?
Well, it seems U.S. inventories built up by about 3.0 million barrels, though gasoline stockpiles did fall slightly, indicating some demand. The oil story here is a bit more nuanced than the broad optimism elsewhere. It suggests supply-demand dynamics are perhaps outweighing those broader monetary policy expectations, at least for now.
Got it. And what about the digital asset world? Cryptocurrencies have certainly proven they can march to their own drum sometimes. Did they join this broader rally in a big way?
Yeah.
I saw Bitcoin briefly topped $124,500.
Yeah.
That's roughly 33% year-to-date gains.
It did.
And Ethereum approached its record high, up a staggering 87% over the last 3 months alone.
Yeah.
That's a lot of movement.
They absolutely joined the party, and with vigor. The underlying support for crypto has been multifaceted. You've got significant ETF inflows continuing to provide a new regulated avenue for institutional and retail investors.
Right, the ETFs have been huge.
Exactly. And a generally favorable regulatory stance in the U.S. has fueled demand and, reduced uncertainty. However, it's really crucial to acknowledge the caution flagged in the brief. Extreme momentum may leave the market vulnerable to macro shocks.
Good point.
While the gains are undeniably impressive, the sheer speed of this rally introduces a degree of vulnerability. If that broader market narrative around rate cuts shifts, or if some significant external event occurs, the crypto space, given its momentum, could see a pretty sharp correction. By the way, if you value customized intelligence that aligns with your specific interests, Nextsight has you covered. Their platform helps investigators globally with deep, actionable insight.
That's a vital point to keep in mind on crypto. Now, let's zero in on the U.S. equity market specifically. What were the sector-level dynamics at play within this record-setting rally? Was it just everything going up, or was there more nuance in where the strength really lay?
Well, the gains were pretty broad-based across the market, which is generally seen as a healthy sign. However, we did see some interesting leadership. Healthcare stocks, for instance, led the way, up 1.6% according to Reuters. These are often considered, defensive names, and they typically benefit from lower yields as their future earnings become more valuable in a lower discount rate environment.
Okay, so defensive's leading. What about tech?
Interestingly, some of the mega-cap tech stocks, despite their powerful run earlier in the year and the overall rally yesterday, actually slipped slightly. This suggests their valuations, which were already quite high, were approaching what analysts consider maybe stretched levels, leading to some profit-taking or perhaps rotation.
So a bit of a rotation happening. What else was driving the domestic story? Any insights from earnings or maybe smaller companies?
Indeed. The Q2 earnings season is largely winding down now. About 92% of S&P 500 companies have reported. And the blended Q2 EPS growth, which combines reported and estimated earnings, is coming in at around 8%.
That sounds pretty good.
It is. Crucially, this is beating consensus estimates by about 5 percentage points. So stronger corporate performance than anticipated, which certainly underpins the market's confidence. Another significant development was the small cap Russell 2000 index. It jumped a substantial 2% to a 6-month high.
Small caps joining in. Why now?
Well, this was largely driven by easing financial conditions. Lower rate expectations significantly improve credit access and borrowing costs for smaller businesses. They're typically more sensitive to interest rate changes than the giants. This also points to a broader factor rotation where cyclical stocks think industrials, consumer discretionary names, things that tend to perform better when the economy is growing are catching up. Meanwhile, mega-cap tech stocks, as we mentioned, are consolidating after their strong run. Suggests investors are broadening their conviction beyond just a few dominant players.
This brings us to a really crucial question, valuations. How are they looking with these lower yields factored in? Does the current market price make fundamental sense? Or are we perhaps, getting a bit ahead of ourselves, pricing in too much good news?
That really is the million-dollar question for many investors right now. The relationship is clear. Lower rates generally justify higher valuations. Future corporate earnings are discounted at a lower rate, making them worth more today. However, if we look at the forward PE, the price earnings ratio on the S&P 500, it's currently sitting around 21 times earnings.
And how does that compare historically?
Well, that's noticeably above its 10-year average of roughly 18 times. So while lower rates help justify this premium, the market brief points out that it leaves little margin for error should earnings disappoint going forward.
Right. Not much wiggle room.
Exactly. In essence, the market isn't pricing in much room for negative surprises. If corporate performance stumbles even slightly, or if that rate cut narrative weakens, these elevated valuations could face a swift reevaluation.
So it's a bit of a tightrope walk. How are investors actually positioning themselves in this environment? Are they piling in or showing some caution? What are the flows telling us?
We saw U.S. equity ETF inflows accelerate, taking in approximately $8 billion last week alone. Broad market and small cap funds attracted most of that interest, which aligns perfectly with that factor rotation we were just discussing.
Okay, so money is flowing in.
It shows a clear appetite for equity exposure and a belief in the broader market's upside, yes. In the options markets, the VIX, often called the fear index because it measures expected market volatility, was priced down at 13 points. That's a fairly low level, indicating a notable degree of maybe complacency among investors, suggesting they don't anticipate significant near-term market turbulence.
Complacency. That can be dangerous.
It can be. And perhaps most critically for the outlook, the Federal Reserve's September meeting is now heavily discounted for a 25 basis point rate cut. The CME FedWatch tool is showing about a 70% probability. That's a very strong market conviction, almost baked into prices already.
To 70%. Okay, let's step back out globally again. Beyond the U.S., how do the rest of the world respond to this wave of optimism, especially in regions with their own unique economic stories? Let's do a quick scan. Asia Pacific first.
Right. In Asia Pacific, Japan's Nikkei 225 climbed 1.3%. That was supported by yen weakness, which helps Japanese exports and strong earnings from industrials. Investors there are expecting the Bank of Japan to raise rates only gradually, so it's still a relatively supportive environment.
And China, huge surge there.
Yeah, China and Hong Kong were significant movers. The Hang Seng surged at 2.58%. Sentiment was hugely boosted by Beijing's clear hints of further stimulus measures and easing property curbs. That addresses key concerns in their economy. Mainland China's Shanghai Composite also gained 0.5%. Korea and Taiwan saw chip sector strength, KOSPI up 1.08%, Taiwan's TAIEX advancing, reflecting global demand for semiconductors. Australia was somewhat of an outlier, edging down 0.6%. Weakness in commodity exporters offset gains in financials there.
Interesting mix. And what about Europe and the Americas beyond the U.S.? Same themes playing out or more local factors?
In Europe, the Stoxx 600 rose 0.54%, again with healthcare leading, reflecting those lower bond yields and a search for defensive plays. Germany's DAX gained 0.67%, UK's FTSE 100 added 0.19%. However, it's important to note Eurozone data were mixed. Industrial production actually contracted slightly, which kind of dampens growth prospects.
So not all smooth sailing there.
Not entirely. And UK wage growth is complicating the Bank of England's path forward, suggesting their inflation fight isn't quite over yet. So while equities rose, the underlying economic picture isn't uniformly rosy. Moving to the Americas, Canada's S&P TSX set another record, largely mirroring U.S. sentiment and its own strong resource sector. Brazil's Ibovespa slipped a bit amid some profit-taking, even as inflation expectations eased there, a slightly different domestic dynamic. And in South Africa, the JSE All-Share climbed almost 1% thanks to mining stocks and a stronger rand.
Okay, quite a global picture. Now, with all this rate cut optimism floating around, how did real assets react, particularly real estate, which has been so sensitive to rate hikes? And what about credit markets? Do they show more confidence?
Yeah, real estate, typically a beneficiary of lower rates, saw positive movement. The All REITs index, which tracks real estate investment trusts, gained 0.87%. Mortgage REITs advanced even stronger, 1.18%. This was significantly supported by lower Treasury yields and those ongoing expectations of Fed easing.
And mortgage rates themselves. For homeowners.
Crucially for homeowners and prospective buyers, U.S. 30-year mortgage rates fell again slightly, down to 6.599%. That's down about 3 basis points from the prior day and roughly 10 basis points over the past month, so moving in the right direction.
That's welcome news for many. What about credit spreads?
In the credit markets, we saw both investment-grade and high-yield spreads tighten. Now, tightening spreads just means the extra yield investors' demand to hold riskier corporate debt compared to safer government bonds has shrunk. This is a clear sign that investors are feeling more confident about companies' ability to repay their debts, indicates improving risk appetite across the board.
Good sign.
And furthermore, the MVE index, which specifically measures bond market volatility, declined to 101. That's its lowest since early June, reflecting increased calm and reduced uncertainty in the bond market.
Okay, so the markets seem quite settled, banking on these rate cuts. Looking forward then, what are the critical events investors are watching? What could either, validate or potentially derail this rally we've been discussing? What's on the catalyst calendar?
There are three key events on the immediate horizon that could fundamentally test this market narrative. Really important ones. First, today, Thursday, August 14th, we get the U.S. Producer Price Index, or PPI, for July. The consensus is for a modest 0.1% month-over-month increase for the core reading.
And why does PPI matter so much right now?
Well, a soft reading here would reinforce those disinflation trends, strengthening the case for that September Fed rate cut, which, as we've established, is what the market is heavily banking on. A hotter print, however, could definitely challenge the rally. It would suggest inflation isn't cooling as rapidly as hoped, potentially pushing back those rate cut expectations.
Okay, so PPI today is key. What's the second critical data point?
Then, on Friday, August 15th, we'll see U.S. retail sales for July, expected to be up 0.3% month-over-month. This provides a crucial read on consumer spending, which, remember, drives about 70% of U.S. GDP.
Right, the consumer is vital.
Exactly. Strong sales could support economic growth, confirming resilience. But the caveat is they also have the potential to maybe revive inflation concerns if demand appears too robust. The Fed would certainly pay close attention to that.
Makes sense. And the third major event, perhaps the most significant for broader policy signals.
The third, and arguably most significant for those broader policy signals, is the Jackson Hole Economic Symposium. That runs from August 21st to 23rd. Fed Chair Powell will be speaking there, along with other global central bankers. Their comments at this symposium often serve like really crucial signals for upcoming policy shifts. Markets will be parsing every single word for clues about the September FOMC meeting. Will Powell confirm the dovish lean, or will he introduce a note of caution? His tone could profoundly shift market sentiment.
So what does this all mean for us, really? Clearly, these upcoming economic data releases, PPI, retail sales, and then the central bank pronouncements from Jackson Hole, they will fundamentally test the market's current dovish narrative and that strong expectation for rate cuts. It feels like a high-stakes few days ahead.
Exactly right. To bring it all together, our trend and risk dashboard offers a concise summary. On monetary policy and rates, the trend is unequivocally bullish for risk assets right now, primarily due to that cooling July CPI data and the strong rate cut expectations. But the primary risk here is hotter data, like a surprising PPI print today, shifting those expectations.
Okay, and growth, inflation.
For economic growth, it's still a bit of a mixed picture. The U.S. shows resilience, but China's recovery remains, let's say, fragile, and Eurozone industrial output is soft. Inflation is indeed moderating, which is good news, but critical components like services and housing costs remain sticky. That's something the Fed is closely watching.
And how about valuations and market positioning as we head into these catalysts? You mentioned complacency.
Yeah, valuation, particularly for U.S. large-cap equities, remains elevated, 21x forward earnings compared to an 18x average. This, combined with what we call narrow leadership in some segments, leaves the market vulnerable if earnings disappoint or if the narrative shifts. Geopolitics and policy are always on watch, with Jackson Hole being the immediate key, alongside evolving U.S. election rhetoric and the true impact of China's stimulus. Finally, market technicals show potentially overbought conditions. For example, the RSI, the Relative Strength Index Momentum Indicator, is over 70. That can signal the market might be due for a breather, a correction. And the VIX near 13, as we said, indicates that degree of complacency. So there's a clear risk of a pullback if these upcoming catalysts disappoint the market's current high expectations.
What an incredible market run we've seen, really largely driven by this optimism around rate cuts, but with clear points of vulnerability as you've laid out. We've highlighted the key data points, the global movements, and the critical events that will shape the coming days. Remember, understanding these interconnected global signals and the narratives driving them is how you truly stay ahead in this dynamic financial landscape.
Absolutely. And maybe something for you to think about as you process all this information. Consider how resilient these current market narratives truly are, especially given the overbought conditions and those elevated valuations we've discussed. What would it actually take for the market's dovish narrative to truly be challenged? And how might you identify those early signs in the very data we've just broken down? Think about the specific thresholds or deviations from expectations that would signal a genuine shift in sentiment.
Excellent point. A lot to mull over. Keep digging into these details and thinking critically about the market's direction. That's it for today's deep dive, your Thursday, August 14th, 2025 intelligence brief. Don't forget to follow us on YouTube and Spotify, and like, share, and comment. We always look forward to hearing your opinion. Enjoy your small Friday.